Good afternoon, everyone. Welcome to today's macroeconomics lesson on fiscal policy. As a start, we will study the definitions of fiscal policy and what is the meaning of a federal budget. First, fiscal policy refers to changes in federal government spending or tax rates for the purpose of influencing the macroeconomy. Fiscal policy is one of two policy tools for managing the economy. Monetary policy is managed by the central bank and is the other type of policy, which will be covered in another lecture. Fiscal policy is normally decided by the US Congress and the US President in the United States. The discussion of fiscal policy focuses on how federal government taxing and spending affects aggregate demand. If you recall, aggregate demand is a total demand for all goods and services in the economy at a given overall price level and in a given time period. For the federal budget, it refers to the government's annual financial plan. It outlines how a national government like the US and Australia plans to raise and spend money. Now, why do we need to study fiscal policy? There are four key reasons. First, fiscal policy decisions directly affect individuals through taxes, government benefits, and the overall economic environment. Second, fiscal policy can be used to moderate the effects of economic downturns by increasing government spending or cutting taxes, which can boost demand and stimulate growth. Third, fiscal policy can also be used to promote long-term sustainable growth by investing in infrastructure, education, research, and development. And lastly, fiscal policy helps determine how government resources are allocated to deliver public goods like healthcare, defense, law enforcement, and emergency services. In the next slide, let us look at the federal budget, which can have three types of state. First, the budget can be balanced, or the budget can have a deficit, and lastly, the budget can have a surplus. In the balanced budget, the government spending and revenue are equal, as you can see on the left-hand side of the icon. When the federal government spends more money than it receives in revenue in a given year, then the budget is said to be in deficit. Similarly, when the government receives more money in revenue than it spends in a year, the budget is said to be in surplus. So there are three types of state again, where the budget can be in balance, deficit, or surplus. Now, I would like us to have a bit of a class exercise where I would like you to guess whether the US fiscal year 2024 budget is in surplus, deficit, or in balance. For the second question, I would like you to do a bit of research and find out the size of the US government's revenue and expenses in the 2024 fiscal year. So let us begin our research for the moment. Okay. I hope all of you have found the answers. So looking at the fiscal year in 2024, US government spending amounted to $6.75 trillion. However, revenue amounted to only $4.92 trillion. As such, there was a deficit of $1.83 trillion for the fiscal year in 2024. Now let us look at how the government spends its money in the budget. On the right-hand side, you can see the fiscal year to date, 2025, for the US government. The big ticket items are Social Security, Medicare, net interest, healthcare, national defense, and income security. Now, for Social Security, it refers to the federal insurance that provides financial benefits to pensioners, unemployed, or disabled persons. For Medicare, it refers to an federal insurance program that provides subsidized or free health care to certain groups of people, such as the elderly, who are above 65 years old, and people with disabilities. These insurance programs are very, very essential to many, many people in America, right? For those that are unemployed, pensioners, or disabled persons, which is why the government has to spend money, a lot of money, on these programs. Now let's take a look at the government revenue. There are many types of taxes in which the government can earn revenue from. First is the estate and gift tax, which is a tax on people who pass assets to the next generation, either after death or during life in the form of gifts. The second type are custom duties, which are taxes imposed on imported goods. These are fees the government charges when products cross the border into the country. And third, corporate income tax, which is a tax imposed on corporate profits. On the individual level, the government does impose individual income tax, which is a tax based on income of all forms received by individuals. Now, if you look at the right-hand side of the graph, the biggest type of revenue where the government gets its revenue from are in the form of individual income taxes, social security and Medicare taxes, and income and corporate income taxes. In the next slide, we will look at the remaining definitions of taxes. So excise tax is a tax on a specific good, such as gasoline, tobacco, and alcohol. Now, the other big component of government revenue comes from Social Security and Medicare tax, which is a federal payroll tax that funds Social Security and Medicare programs. So having looked at all the government revenue and government spending, now let us look at how the US deficit is related to the national debt. In a given fiscal year, when the government spending exceeds revenue, a budget deficit results. To pay for this deficit, the federal government has to borrow money by selling marketable securities such as treasury bills, treasury bonds, notes, floating rate notes, and treasury inflation protected securities, otherwise known as TIPS. The national debt is the amount of money the federal government has borrowed to cover the outstanding balance of expenses incurred over time. So what this means is that if you look at the right-hand side of the graph, for the fiscal year, we have a current deficit of $1.83 trillion. But if you look at all the previous years, from 2000 to 2020, almost every other year, there has been a deficit. So the government has already borrowed a lot of money during this period of time to be able to finance its budget. So that national debt is the total amount of money the federal government has borrowed to date to cover the outstanding balance of expenses incurred over time. So the national debt, like I said, is the accumulation of this borrowing along with associated interest owed to the investors who purchase the securities. The total national debt for the United States as of 2024 stands at $35.46 trillion. As the federal government experiences recurring deficits, which is common, the national debt grows. So now let us talk about expansionary and contractionary fiscal policy. Now, expansionary fiscal policy is where the fiscal policy increases the level of aggregate demand either through increases in government spending or cuts in taxes. On the other hand, contractionary fiscal policy is where the government decreases the level of aggregate demand through cuts in government spending or increases in taxes, right? So if you look at the past few years of the fiscal policies, it can be said that expansionary in nature, right? Where the government is trying to increase the aggregate level of demand through increases in government spending. So in summary, what have we learned? There are a few key points I want you to take away from today's lesson. First, fiscal policy involves government decisions on spending and taxation. When the government spends more than it collects in taxes and custom duties, it runs a budget deficit. To finance the deficit, it borrows money, which adds to the national debt. Expansionary fiscal policy, such as tax cuts and stimulus spending, can increase deficits and debt in the short term. On the other hand, contractionary fiscal policy, such as spending cuts and tax hikes, can reduce the deficit and slow down debt growth. Lastly, persistent deficits year after year causes the national debt to rise over time. With that, I thank you for listening to today's presentation and hope you have a great day. Take care.